Okay, welcome to our High Rock clients and any other listeners who have joined us this week. And thanks for taking the time to tune in to our weekly webinar where we're going to talk about what we see happening in the global economy, financial markets, and the world of wealth management. And I'll get to a few highlights of today's Canadian government budget. And all the things that impact our decisions on the best courses of action for our and your investment strategy. We are recording this webinar so that those who can't join us live can tune in when it is more convenient. I'm Scott Tomlinson, and my partner, colleague, Paul Tepsich will not be with us today. He's off skiing, well, actually watching his son ski race in Quebec at the Canadian National Snowboarding races. So good luck to Paul's son Nicholas in his quest to become a Canadian national champion. But our financial planner Bianca Tomlinson is on the call, so we'll still have our question and answer period at the end of the call. If anyone has a question about any aspect of wealth management, we invite you to feel free to ask us questions. If you're a first-time listener and would like a little more information about our private client services and our disciplined investing strategy, we have a separate introductory webinar that will provide you with this on our website under the About High Rock tab. Well, as we do every week, let's quickly recap our themes for 2016 before we get started on what happened over the course of the last week. Our overriding theme for 2016 is that financial markets will remain volatile. January saw a spike in volatility, but markets settled a bit in late February and so far in March. Thanks to continued monetary stimulus by central banks, volatility has slipped back to the low levels of last October and well below their longer-term averages. Just an eerie calm before the storm, perhaps. The big question remains whether or not the U.S. economy will continue to be able to grow while less positive global economic forces provide a drag. The consumer is not, at the moment, providing a lift to the domestic economy, despite improving employment growth. And at the wholesale level, inventories are building while sales are sliding. Commodity prices, and especially oil, have stopped declining for the moment. Core inflation in North America has picked up, but not so in other parts of the global economy. The European Central Bank increased its monetary stimulus. The Bank of Japan had done so as well. The Bank of Canada is on hold until they're able to analyze today's budget. We'll get to that shortly. The U.S. Federal Reserve has pulled back from tightening, and the Bank of England also remains on hold. Geopolitical wild cards, like the UK leaving the European Union, the Donald Trump factor, OPEC and oil-producing nations, China, North Korea, terrorist activity, and we saw some of that rear its ugly head today, and the refugee crisis are all increasing the levels of uncertainty. We continue to watch bond markets for clues, but with some central banks forcing negative interest rates, is the picture being somewhat distorted? Are other credit markets like high yield telling us a different story? Will equity markets remain expensive, although somewhat less so than last May? Earnings growth has declined over the last 3 quarters, will probably decline in the first 2 quarters of 2016, and estimates for all of 2016 continue to be revised lower. Will we remain in a time of lower than average returns when, after 6 years of above average returns, and as the cycle evolves, longer term returns are moving back toward the average? Well, plenty has happened since our last webinar, so let's get right to the financial markets because there's always lots going on there. In keeping with our key theme for 2016, it has been a wild ride since the beginning of the year. Volatility started the year off with a boom, but has eased up recently as the Bank of Japan, the European Central Bank, and have added further monetary stimulus, and the Federal Reserve in the U.S. last week refrained, as did the Bank of England, from increasing interest rates. So at the moment, we see volatility somewhat reduced. And volatility currently now below its longer-term averages. Well, CNN Money's Fear and Greed Index hit a low near 9 in January, but now it has moved back into the extreme greed territory as more stimulative central banks have forced money out of negative yielding safe assets into riskier assets. Markets have moved rather quickly from being oversold to overbought. Now we suspect that the next move will probably be to the downside. Since our last webinar, our benchmark World Equity Index is stronger by a little under 2% and is now slightly positive on the year. Last week it was lower by about 2%. China's Shanghai Composite was the best performer since last Tuesday, as well as emerging markets. Both were rather tied, I guess, for strength. And again, based on the lack of any interest rate increase from the U.S. Federal Reserve. Switzerland's SMI index was the worst performer. Back in December, I suggested that it might be a reasonable strategy for 2016 to be overweight the underperforming at that time Canadian equity market and underweight the outperforming U.S. equity market for rebalancing purposes. Well, at this time, that strategy is working very nicely. On a total return basis, which includes dividends and currency fluctuations, the TSX is up by about 5.5%, while the S&P 500 in Canadian dollar terms is down by about 4%, which is a difference of just a little over 9%. So the TSX has been the best performing country index in the developed world this year. After hitting the highs last May near 63, our benchmark World Equity Index made new lows near 49 in mid-January and then again in February, which was a 22% drop from the highs. Now then, it found some buying support from short covering and a little bit of value investing after such a significant decline. The downtrend channel, however, still remains intact as we are now experiencing lower lows and lower highs. We are seeing some buying, driving prices to test the top of the downtrend channel at or near 56, which is a 50% retracement from and a bounce of close to 14% from the lows. A break of that channel to the upside would change the medium-term outlook to positive. However, until this pattern and the downtrend is broken, we should be on guard for further selling pressure, especially as markets are close to overbought territory. Also notice that trading volume has fallen considerably as markets rebounded from the lows. Without volume follow-through, this move will likely run out of momentum to the upside. Until we see further positive developments, we are sticking to our overweight cash thesis in our portfolios and our models. Well, it was a positive week for fixed income as Canadian preferred shares were the best performer. High yield was not far behind. Easier central bank monetary policy expectations continue to drive investors into higher yielding assets. The Canada-US 10-year interest rate spreads narrowed by a couple of basis points to 61 basis points over the last week from 63 basis points the week before. Oil continued its move to the upside this week. Oil has clearly broken out of the downtrend channel, and the next near-term resistance looks to be near about $45 per barrel. Also, the Bloomberg Commodity Index continues to move higher in sync with oil prices. Well, the Canadian dollar, after closely tracking oil prices as they fell, has jumped ahead as they rise, perhaps getting ahead of itself somewhat. Now, steady rates from the Bank of Canada and increased deficit spending expectations from the government are the key drivers here. This will concern the Bank of Canada as it does not want to see a higher Canadian dollar because it wants to see lower Canadian dollar driving export growth and helping to boost the economy. Well, our benchmark World Equity Index is comprised of about 52% of U.S. companies, so we do keep a close eye on what's going on in the U.S. economy. The FOMC, the U.S. Federal Reserve, believes that the economy has been expanding at a moderate pace. Now, I underline has been because that is historical information. They expect this to continue with a big however, where global economic and financial developments continue to pose risks. And as per usual, that interest rates will depend upon incoming data. Well, in December, the FOMC members anticipated an average of 4 interest rate increases, which would have represented a full 1% for 2016. That would have taken the federal funds rate up to 1.5%. As we suspected and have been saying for a number of weeks, they have modified this stance as economic conditions remain under pressure. It now appears likely to them that there might only be 2 increases this year. We might still suggest that that could be optimistic. While the Fed's mandate is to foster maximum employment and price stability, and inflation is starting to move higher towards their 2% target. Meanwhile, jobless claims higher last week. The trend continues to be sideways at the lower levels in this leading indicator of the state of U.S. employment, which at the moment remains quite strong. However, most of the growth has been in lower paying jobs. Strong employment at the moment and rising inflation could very well prompt the Fed to want to raise interest rates. However, looking a little deeper, retail sales data had a big downward revision in January and shows that the consumer is not spending this year thus far. Now, consumer spending, despite high employment, is struggling to break out of a flat run that included a very soft holiday season. The consumer is roughly 2/3 of the U.S. economy and is key to supporting domestic economic growth, which is being offset by the slow global economy at the moment. Well, high inventories have warranted a slowdown in manufacturing. The manufacturing index picked up slightly in February, but remains in contraction below the 50 level. And industrial production, which was the data which came out last week and actually contributes less than 20% of the U.S. economy, looks like it has reversed course in February. Well, the GDP Now model forecast for real GDP growth in the first quarter of 2016 is at 1.9% as of last week. Now, the forecast first quarter real consumer spending growth fell from 2.7% to 2.5% after the Consumer Price Index and industrial production releases from the U.S. Bureau of Labor Statistics and the Federal Reserve, respectively. The forecast for non-residential structures investment growth fell from -6.8 to -9.2% based on February oil and gas well drilling data. These declines were offset by an increase in the forecast for residential investment growth from 12.3% to 14.6% after the housing starts released from the U.S. Census Bureau. So while the consumer is not spending, or at least waiting to spend, business investment is slowing, but residential housing investment appears, for the moment, to be driving the economy. The question there is this sustainable? Well, it's expected the U.S. economy will contribute to 20% to global economic growth. One of our themes for 2016 asks, will that be enough? Well, as I have mentioned this morning in my blog, we have discussed one particular relationship that has concerned us, the high inventory to sales ratios and their relationship to recessions in the past. As inventories rise and sales fall, companies have to reduce production and prices, and earnings fall until costs are cut. So that's one indicator that we keep an eye on. However, here's some more indicators. Another couple that we want to add. The first is the relationship between the ratio of coincident indicators to lagging indicators. Now, historically, this indicator has fallen in advance of a recession, and it is falling now. So what is a coincident or lagging indicator? Well, a leading indicator of economic activity would be data such as the average work week, jobless claims, new orders for goods, building permits, and stock prices. A coincident indicator of economic activity would include the non-farm payroll data, industrial production, and business sales. Lagging indicators include duration of employment data, inventory to sales ratio, which I've mentioned before, credit and lending data, labor costs, and consumer prices. So lots of stuff there. But when coincident economic indicators fall faster than lagging indicators, it is a sign that the economic cycle is actually running out of steam. So this concerns us as well. Historically, corporate profits have turned lower preceding recession. Corporate profit growth has been declining in the previous 3 quarters and is expected to fall in the first quarter of 2016. So these 3 indicators leave us more than a little concerned about the state of the U.S. economy. We think that although they want to maintain a positive outlook for fear of frightening the consumer, the Fed is also quite concerned as well. Okay, what's happening in the rest of the global economy? Well, euro area companies represent 16% of our benchmark world equity index. On March 10th, Mario Draghi put his Super Mario costume back on and surprised financial markets with a number of new monetary policy measures intended to assist economic growth and spur inflation. The European Central Bank lowered its benchmark refinancing rate by 5 basis points to a fresh record low of 0. Increased the asset purchases program by $20 billion to $80 billion a month. The deposit facility rate was cut by 10 basis points. The lending facility was lowered by 5 basis points, and a new series of long-term loans to banks was announced. Policymakers said interest rates are expected to remain at present or lower levels for an extended period of time, and they cut the growth and inflation forecasts. This outlook is broadly reflected in the March 2016 European Central Bank staff macroeconomic projections for the euro area, which foresee annual real GDP increasing by 1.4% in 2016, 1.7% in 2017, and 1.8% in 2018. Well, Japanese companies represent 8% of the world equity index. Now, in February, the Bank of Japan surprised financial markets with their first step into negative interest rates. At last week's or the previous week's meeting, there was no change to monetary policy. The outlook, although remains with sluggishness, expected to remain in exports and production for the time being. Domestic demand is likely to follow an uptrend with a cycle from income to spending being maintained in both the household and corporate sectors. And exports are expected to increase moderately on the back of emerging economies moving out of their deceleration phase. Thus, Japan's economy is likely to be on a moderate expanding trend. The year-on-year rate in the CPI is likely to be about 0%, so no inflation at all for the time being due to the effects of the decline in energy prices. And as the underlying trend inflation steadily rises, move towards 2%. Companies in the UK represent 7% of the global equity index. Last week, the Bank of England Monetary Policy Committee voted unanimously to maintain the bank rate at 0.5%. Policymakers said inflation remains weak and noted that the uncertainty surrounding the referendum on UK membership of the European Union may delay spending decisions and depress growth into the future. Now, Britons will vote on June 23rd whether or not to remain in the European Union. There are potentially significant economic implications for the UK as their participation is considered somewhat economically crucial. At the moment, the polls are showing that those who wish to remain in the Union hold a very slim advantage. The pound has been under continued pressure but has bounced off of its recent lows. Chinese companies represent 2.5% of the world equity index. On the end of February, in an aggressively stimulating move, the People's Bank of China lowered the amount of deposits banks must hold in reserve by 0.5 percentage point. In February, China reported its largest monthly drop in exports since the financial crisis Exports fell 25.4%. Imports also declined as well. Factories and retailers in China put in weaker than expected performances in the first 2 months of the year. In Canada, where companies represent 3% of the world index, well, today we had the budget. And very quickly, the winners are universities and students, indigenous communities, startups because stock options were not touched, veterans, and infrastructure companies. Although infrastructure spending may not be as fast as some had expected, the government is still committing $120 billion in spending over the next decade. The big losers from the budget, small business owners, the tax rate was set to eventually drop to 9% by 2019, but the budget freezes the rate at the existing 10.5%. High income earners, so Canadians who earn more than $200,000 a year will see taxes go up, and their eligibility for child care, as well as grants for post-secondary education will not be permitted. Now, charities. The previous government had set a plan to begin allowing people to avoid capital gains taxes on stocks and real estate donated to charities, but the new budget does cancel that plan change, and this likely will not be a positive development for charities. Well, some people ask, does Canada have room to increase their deficit spending? Well, certainly Canada is the least, in a good way, has the lowest net debt to GDP in the G7, the group of G7 countries. So certainly Canada does have some room to spend. However, in a time of low interest rates and high household debt, something that the government of Canada has to be careful of is leading by example. And perhaps as we dig deeper into the spending, hopefully it is for good things. We'll have a closer look overnight and have more to say about that tomorrow in my blog. Okay, what do we see coming on the horizon? Well, let's check in with bond markets as we do each week. Negative rates, yields for Japan and Germany in the short term, just out to 8 years now for Germany, beyond 10 years on the maturity spectrum for Japan, and flatter yield curves are not positive economic developments as the inflation outlook is not expected to move higher anytime soon. Certainly that flies in the face of what the European Central Bank and the Bank of Japan are trying to achieve. We remain to see what happens as far as the Canadian yield curve after the budget. Certainly the UK and US curves have really not moved much as the expected results from their respective central bank meetings were pretty much in line with expectations. Well, historically, high-yield bond markets lead equity markets, and while the current gap remains to be closed, it does make equity markets still look relatively expensive, although high-yield bonds have recently rallied fairly significantly behind the rally in the S&P 500. We look to see how this evolves over time, but we think that that gap still has some narrowing to do. Canadian high yield continues to lag U.S. high yield in that most recent rally as well, something to keep in mind. And we've talked in the past about the potential of increased defaults in the energy sector to impact high yield bonds and in longer term the financial system as a whole. Well, as for equity markets, nothing new really here, but as we say, when investors buy stocks, they buy a stream of future earnings. The price to earnings ratio represents a metric to measure stock prices relative to earnings. Now, the 10-year average price to earnings ratio is 14.2. The 12-month forward-looking price-to-earnings ratio is currently at a rather expensive 16.5. Last week it was at 16.1. At the equity market highs way back in May of 2015, it was 17.1. So on a relative basis, we're looking at a very expensive S&P 500 at the moment. As a result of downward revisions to earnings estimates, the estimated year-over-year earnings decline for the first quarter of 2016 is a very large negative 8.3%, which is well below the expected earnings growth of 0.3 at the end of 2015. It would be the fourth consecutive quarter of negative earnings growth. Now, for all of 2016, analysts are projecting earnings increases of 2.5%. That's down considerably from the beginning of the year, where analysts were projecting rate of earnings growth of 7.4%. So as I mentioned earlier, profits are declining, and that can't be a good thing for the economy overall. Now, as we say, when the green dotted line, the S&P 500 prices, pull back to the blue line, which represents S&P 500 earnings, we can get more comfortable buying S&P 500 companies. But until then, we remain on the sidelines. We've maintained for almost a year now that stocks were expensive on the many different metrics that we monitor. So who is doing all the buying? Well, last week we pointed out that corporations buying back their own shares are really the key drivers of the most recent stock market rally. The white line shows the amount of corporate buybacks, which are reaching levels that we haven't seen since 2007. Now, instead of paying out dividends or investing in capital expenditure for future growth, corporations have been buying back their own shares and driving share prices higher. This becomes self-serving to a degree, as chief executives are often compensated on their company's share price. Retail investor buying of mutual funds peaked in the final quarter of 2014, as shown by the bar graph of money flowing in and out of mutual funds. For 2015 and the beginning of this year, we show negative outflows. The recent rally in stocks pushed the enterprise value to earnings ratio higher, back towards 13 times and well above the longer-term average near 10.5. This has prompted us to take some sales to further lighten our exposure to expensive U.S. equities. Now, when investors borrow to invest, it can drive stock prices higher. When they pay down their loans, they tend to sell. So margin debt data tends to provide an indication of equity market direction. Margin debt turned lower last May and lower again in January of this year. That trend definitely inspires caution towards equity markets. When the spread between large cap markets like the S&P 500 widens over small cap markets like the Russell 2000, it is historically a sign of stock markets that are rising on the strength of fewer and fewer companies, and is considered unhealthy. The markets fell, that gap narrowed considerably, but that gap has widened as large cap markets have rallied more, while the broader Russell 2000 has lagged. This also does continue to make us cautious. So what does it all mean? Nothing's really changed over the last few webinars. Last May, we took a defensive posture to investing, and we remain defensive at this particular point in time. We picked away at some value opportunities, but remain overweight cash for the foreseeable future. Central bankers and most economic forecasters are uncertain of the path of the global economy, so are we, and as Paul suggested in the Globe and Mail article a number of weeks ago, we are somewhat worried about the prospect of deflation and its potential effect on capital markets. Now, our discipline, as we often refer to it, is at all times to protect our and our clients' capital, and especially so when we see the warning signs of potential problems developing. It's easier to be and stay fully invested at all times. That is why most advisors might recommend sitting tight on a fully invested strategy. Now, in many cases, as non-discretionary advisors are required to do, it is significantly more difficult and time-consuming for advisors to adjust assets and positions one household at a time. That is why we use discretionary management, so that we can move all of our clients at the same time. We can be quicker, more efficient, and more impactful. Cash and cash equivalents have been and continue to be important defensive assets, so we are carrying greater than normal cash balances in our models. Now, with equity market values having fallen so rapidly to begin 2016, we were able to find some opportunities to add reasonably cheap assets to client portfolios. However, this does not change our defensive strategy. We are being patient and only adding small percentage weightings at a time, leaving for future equity market weakness and assets with better value if and when we should get them. Now, if we don't get them, we can and will adjust our strategy accordingly, and we can do this very quickly. Remember that the core of most client portfolios is a long-term strategy based on your personal wealth forecast, goals, risk tolerance, and time horizons. However, the ongoing research and analysis that we do at High Rock will dictate the minor adjustments in short-term strategy that we make in our models, which we believe add value to the long-term performance. And that is how we can justify our fees. Our High Rock models are built to incorporate the need for diversity and balance with fixed income, global equity, and tactical mid and small cap companies. Because our key theme for 2016 is focused on greater levels of volatility, the cash or cash equivalent component in client accounts, the underweight exposure to equity markets, the overweight exposure to safe government bond markets, and helps us to mitigate the impact of volatility on our portfolios. On an administrative note, clients should have received a gain-loss report for taxable accounts as well as a checklist so that they can make sure that they've received all of their slips prior to filing. If you do have any questions about your tax issues, please make sure that you get in touch with us. Okay, as we do every week, let's have a look forward and see what's coming up over the course of the next week. Nothing tomorrow. We will see the latest on retail sales in the UK. We'll see some information on Japanese inflation on Thursday. On Friday, it is the Good Friday holiday, but we will see the latest revision to fourth quarter U.S. gross domestic product. Next week, Monday, we'll see personal income and spending out of the U.S. for February. We'll see core February PCE price indices, which is the U.S. Federal Reserve's key indicator for inflation. And we'll have a peek at what's gone on in the employment data in Japan. On Tuesday, we'll get the latest consumer confidence readings in the U.S. Of course, we will have our regular High Rock webinar, and we'll also get a peek at what's going on in the industrial production in Japan. Okay, well, thanks for listening in today. That's it for today's discussion. But if anyone has any questions, please, this is the time. Feel free to ask. Okay, well, I guess we've covered almost everything that anybody who's on the call wants to know, but if you do have a question and wish to email us, we would be more than happy to get your questions and get your feedback on these webinars, what you think is good, what is not, and what else you might like to see us cover on these calls. As always, thanks for taking the time to tune in. Have a great rest of the week, a great Easter weekend, and don't forget to tune in next Tuesday. And until then, this is Scott Tomlinson signing off.